Welcome back to Edu Vedanta Smart Classes. In our previous video, we explored the basics of monetary policy and its objectives. Today, in part 2, we'll dive into the instruments used by the Reserve Bank of India to regulate the economy. Let's get started. The first tool we'll discuss is the bank rate. This is the interest rate at which the RBI lends money to commercial banks without requiring any collateral. By increasing or decreasing the bank rate, the RBI can control the borrowing costs for banks. For example, if the bank rate is increased, the credit's availability in the market taken from banks decreases, which in turn affects the economy's money supply. Next is the cash reserve ratio, or CRR. This refers to the percentage of total deposits that banks must keep as cash with the RBI. By increasing the CRR, the RBI reduces the funds available for banks to lend, helping to control inflation. Note that the Department of RBI, which is responsible for CRR, is called DICGC, Deposits Insurance and Credit Guaranteed Corporation. Similar to CRR is the statutory liquidity ratio. Banks must maintain a portion of their deposits in the form of cash, gold, or government-approved securities. This ensures the financial stability of banks while regulating liquidity. When SLR increases, the credit availability decreases. The repurchase option rate, in short repo rate, is the interest rate at which banks borrow short-term funds from the RBI by selling securities in order to meet cash withdrawal demand of the customers during certain occasions and festivals. Low repo rates encourage borrowing and boost spending. On the other hand, the reverse repo rate is the rate at which banks lend money to the RBI. This helps absorb excess liquidity in the economy. In both cases, when repo rate or reverse repo rate increases, the credit availability decreases. The RBI also uses open market operations, or OMO. By buying or selling government securities, the RBI can regulate the liquidity in the market. For instance, selling securities reduces liquidity, while buying securities increases it. The liquidity adjustment facility includes repo and reverse repo operations, allowing the RBI to manage short-term liquidity mismatches effectively. It is like a both-way loans between banks and RBI with no fixed time limit. Marginal standing facility. During emergencies, banks can borrow funds overnight from the RBI through the marginal standing facility at a rate higher than the repo rate. This ensures liquidity during extreme shortages. Now let us look into the qualitative instruments. At first, let's see selective credit control. It targets specific sectors to restrict speculative activities. For example, the RBI may limit credit to sectors like food grain storage to prevent inflation. The marginal requirement is the percentage of the loan value that borrowers must finance themselves. For instance, if the RBI sets a 25% margin on loans for stocks, banks can only lend 75% of the stock value, preventing overleveraging. In simple terms, it can be called as the loan down payment. Moral suasion. The RBI also uses tools like moral suasion, where it advises banks to follow policies in the public interest. Additionally, credit rationing involves limiting credit flow to certain sectors to maintain financial discipline. It helps to develop certain sectors selectively. In summary, the RBI uses various instruments like CRR, repo rates, and selective credit control to stabilize the economy and ensure sustainable growth. That's it for today's session. Don't forget to like, share, and subscribe to Edu Vedanta Smart Classes for more such content. Also follow us on Insta and Facebook for more updates. See you in the next video.